Hello and welcome to UTI Swatantra. We are going to be talking about exchange traded funds. Now, the first question you might ask is what are they? Why is everyone perhaps talking about them? And why you could be perhaps looking at them as a way to invest in the markets, and how could they benefit you, whether financially, in terms of what you save, and the way they work. And that really is the most important question that we are addressing today with Shravan Kumar Goel. He is a fund manager, exchange traded funds and index funds at the UTI Asset Management Company. Shravan, thank you so much for joining us today. So, exchange traded funds sometimes to me sounds like a very exotic thing, right? You don't know, it sounds like it's pegged to some exchange traded instrument, but you don't know what it is, how it works. Does it go up when the index goes up? Does it go down? Does it go in opposite directions? Do I make money all the time? Do I lose money all the time? So, tell us about exchange traded funds and why one should be even thinking about them.
So, exchange traded are passive funds which are traded on the exchanges. So, as a layman or as a small investors, one can buy these funds through NSE and BSE stock exchanges, because these funds are traded on exchanges. And these particular these particular ETF funds are linked to a particular index, for example, Nifty 50. So, the objective of ETF and index fund is to mimic the benchmark in terms of portfolio allocation. So, as a portfolio manager, my job is to just buy same securities and in the same proportion as underlying benchmark. In other words, I am not taking any sector or stock calls while managing ETFs and index funds.
So, therefore, you should know what the index comprises of before you invest in an exchange traded fund, and you should surely know which index it could be tried. Could it be tried to different indices or just one Nifty 50 or?
One ETF can be linked to a particular index. There are about 88 ETF and index funds, ETF funds in India, which are linked to various indices.
So, what's the most popular one?
The most popular one is Nifty 50, wherein almost 2/3 of the AUM is chasing Nifty 50 currently in India. It's a broad market index of 50 largest and most liquid 50 blue chip companies in India. And these 50 companies accounts for almost 65% of all the listed companies in terms of free float market capitalization. So, by investing in Nifty based ETF or index fund, you are getting almost 2/3 exposure of Indian equities.
So, I'll come to the philosophy of chasing index fund, but since you use the word chasing, does it mean that this fund will follow the index, or does in some ways, and if so, what is the lag? I mean, for instance, let's say the market fell 2,900 points today. So, which means tomorrow my fund will start showing the same reflection of composition, or is it something that's happened simultaneously?
So, as a passive fund manager, my objective is to keep portfolio as similar as benchmark, but practically it's impossible to follow at the last digit. But typically daily return differential between fund and benchmark is far less than 1 basis point, which is far less than even 0.01%.
So, you are saying the mirroring happens so quickly,
Just to point it out that the tracking error, which shows the relative mimicking of the fund vis-a-vis benchmark, the tracking error of few of the Nifty based funds in India is as similar as few of the global peers who are having almost 100x market cap or 100x fund size.
So, that's how it works. So, tell us, why should one invest in an exchange traded fund, and what is the philosophy behind investing in exchange traded funds?
So, as a first time investor, a person who don't understand the nuances of equity investing, rather than straight away jumping into exotic products, he should start his equity investment journey through a simple to understand equity products. So, at the end of the day, as an investor, you should know what you are buying. If you are investing in an exotic product, at the end of the day, you don't know what you have bought and what is the purpose behind buying that particular fund. So, for example, a broad market index fund like Nifty 50 or Nifty Next 50 is giving you exposure to large cap segment of Indian equities. As you are aware that Indian equities is the best vehicle to participate in the long term India growth story, and as a small investor, as a first time investor, one should start their equity investment journey through a simple to understand product.
So, you are saying an exchange traded fund by definition is a simple product?
Simple product.
Because but it also means that I believe that the only representation of a market is the index. And but could that be a right or a wrong way to look at things?
So, for example, if there is an index which is built on all the listed companies in India, there aren't any,
say 5,000
companies, there are 5,000 listed companies in India. If a particular index providers build a fund which is mimicking all the listed companies in India, which means your returns is aggregate of all the market participants' return. So you are directly mimicking the entire
Right.
listed company space, but practically it's impossible to have any kind of any fund which is having 5,000 securities. So just by investing in Nifty and Nifty Next 50, both put together captures about 80% of all the listed companies in terms
Correct.
of market cap. And generally ETF and index funds, since these are passive funds, whenever market matures, initially these funds are better to start investing rather than starting with a smaller or micro
Right.
cap based.
And I referred to the cost of investing in such funds. Now, one of the propositions or the selling propositions is that it's cheaper in a way, because the expenses that I pay to the fund manager who manages his funds is much less. So, one is, why is that as compared to other funds? Is it because the fund manager is not putting any real effort? And is this something that really helps me in the long term as an investor?
So, two biggest advantage of ETF and index fund is simplicity of investment and low cost. And in the long run, low cost does matter. So, for example, just to give you a simple example, if a person has started a SIP of rupees 10,000 and if it is compounding at 12%, it will become about 99 lakh rupees in 20 years period. As compared to same investment compounding at 10% will become 76 lakh rupees. That's a whooping difference of almost 23 lakhs. So, in 20 years, by investing 10,000 rupees SIP per month, you have invested 24 lakh rupees. So, it has become 4x as at 12% compounded as compared to 10% compounding, which will become 3x. Why I am saying the difference of 2%? Because typically in India, actively managed total expense ratio hovers around 2 percentage point, while a good Nifty based index fund is available at around 10 basis point, which is 0.10%. So, 2% cost differential makes a lot of difference in the long run.
And the term you refer to is 20 years.
20 years, right.
20 years. And that is, you saying 20 years I could save 20 lakhs if I...
23 lakhs, right.
23 lakhs for a 10,000 rupees if I went for exchange.
So, it's a 4x as compared to 3x.
Yeah.
So,
right. So, and yet not everyone goes for exchange traded funds, right? So, why is that?
So, for example, there should be incentive for market participants to pitch a product to retail investors. Since in India currently it's a more of a distribution based model, wherein mutual fund companies are paying to distributors. So, actively managed funds have some ability to pay distributors for their efforts, but since we have started at very low total expense ratio, just to mention that total expense ratio of Indian actively passively managed funds is very comparable to global peers, which are having almost 100x size. So, that's the main reason why it is taking time to pick up for retail investors to invest in passive funds.
Got it. Okay, so now suppose I want to select a ETF to invest in or put my money in, whether it's an SIP or one bulk lump sum. What are the 2 or 3 things that I should first look at?
There are 4 critical aspects according to me you should look at while investing in any passive funds. First one is total expense ratio. That is cost that you are paying for buying that particular passive funds.
So, you are saying even between exchange traded funds there could be a variation?
So, just to mention, in the sense in India ETFs and index funds are available as low as 5-7 basis point to as high as 1 percentage point.
Okay.
So, within index and ETF funds there is a
a
wide
gap.
variation.
Okay.
So, you should ideally pick a fund, ETF or index funds which is charging much lower as compared to its peers, because cost save is money earned. So, it is adding directly to investors' returns.
Got it.
Second is size of the fund. Decent size is required to efficiently manage a passive funds. If size of the fund is smaller, then in that case incremental inflow and outflow will impact the fund, because in ETF and index, especially in index funds, any cost because of inflow or outflow is borne by the existing investors. If the size of the fund is larger, which means the incremental impact of inflow and outflow will be far lesser as compared to a smaller size fund. Third is tracking error. It's more of a technical word, but just to simplify it, tracking error shows the consistency of the fund tracking its underlying benchmark. So, typically a fund which is mimicking its benchmark very closely will have lower tracking error. So, for example, if I am following same stocks and same weightages as benchmark, in that case my tracking error will be much lower as compared to my competitor.
So, could it happen that as an investor on a day when the market crashes 3,000 points, I would want you not to track the index, and will that help?
No. For example, the main objective of ETF or index fund is to match the benchmark return.
Right.
So as an investor, you have taken a call that I want market
Right,
return,
right.
which is reflected by.
Right. So I've signed up for it, so I have no choice now to
You don't have any
live
choice,
with it.
right.
And of course, I benefit if it goes up as well.
Right, right.
Right. Okay. So in the time period that you've seen exchange traded funds, would you say that overall they have delivered what they've promised?
Very much. For example, I would say we have seen that there is a humongous growth in ETFs and index fund in last 3 years. 3 years back, size of ETF and index funds was just 5,000 crore in India. Now it has more than 1.5 lakh crore. So almost 30x growth in just 3 years period.
Correct. But that's also a period where the market has been sort of seen a secular rise, which may not be the case now. So you think that could change things?
So for example,
or should that change things for investors?
So I will compare performance of passive funds vis-a-vis actively managed funds. So if you look at actively managed funds are finding it difficult to beat the benchmark on consistent basis. In last 3 years, more than 50% of actively managed funds have underperformed their respective benchmark.
Okay.
And because of high cost of higher total expense ratio, the end return in the hands of investor is much lower. Because in the long run, actively managed, so all the actively managed funds put together will generate market returns. Why? If they are, suppose for example, if they are just 5 investors and they have only 5 securities or 10 securities to invest in. So everybody will invest in those securities in different proportion, but aggregate returns of all the 5 investors will be equal to market returns. But you have to pay higher cost for managing actively. So in the end return in the hands of investors will be slightly lower as compared to aggregate market returns.
Right. So there is this, people say that you should not, or rather, why should you buy index funds if they do not generate alpha? So what does that question mean? Because we've been getting that question, and how does, as an investor, look at it, and how do you as a fund manager put it in context?
Right. Yes, you are very much right that actively index funds don't generate alpha. But the major question here is, do we know which funds will generate alpha going forward?
What does alpha mean?
So alpha means outperformance of the fund vis-a-vis its underlying benchmark. So alpha generating funds are only known in hindsight. So in the sense, we can just look at history that these kind of funds have outperformed while these kind of funds have underperformed. But there are very few funds which have consistently beaten the benchmark.
Okay.
So as a first time investor or as a small first time investor, your main objective is to generate market returns. In the sense, you want to participate in the long term India growth story, and through simple to understand low cost passive funds, you can achieve your objective. And rather than identifying, doing research on your own to invest in a better fund or better securities, it's better to excel in your own field. For example, if I am a professor, so my skill set lies in teaching rather than investing. But if I am trying to get into investing, if I am trying to excel in investing, which is not my core competency, in that case I may end up generating even lower returns.
Correct.
So one should focus more on its core competency and invest in a passive funds which are simple to understand, but will take you to your investment journey.
Right. And what's the kind of horizon? And so you said that 3 years has been the period that we've seen the growth of this industry. But as you look ahead, is there a horizon that one should have, or how should one distribute one's portfolio so that one has index funds and non-index funds, if so?
So typically equities are by nature are for very long term. So ideal time horizon is as long as you can hold. So I would suggest you to follow your asset allocation and goal based approach while investing. So one should invest in equities to meet your long term objective or long term financial goals. And as your financial goals becomes nearer, you should reduce exposure towards equity. Second aspect is how critical that particular objective is. So for example, if I am investing for
and
my
when you say
child's
long
future,
term, in general you mean 10 years plus, 15, 20 years, like that, right?
generally we have seen that typical market cycle is 7 to 8 years.
Okay.
So
anything
why
beyond that is long term, or?
So typically anything more than that is long term.
Okay.
So ideally, if you are investing at any point and redeeming, say, at the same business cycle, which means that you are not going to suffer because you have invested at peak and exited at bottom. That's why we say that one should follow SIP approach. One should continuously invest, and whenever markets are trading at attractive valuation in terms of forward valuation, one should top it up by investing more in terms of lump sum.
Correct. So the same question from a slightly different angle. What kind of investors should be investing in index? In the sense, what should I be of a certain mindset, investing mindset, to put my money in index funds, or is it open? Is it open for any kind of investor, high risk, low risk, medium risk, and so on?
So I would say passive funds should be core part of any investor's portfolio.
Okay.
So even Warren Buffett and most people advocates that in the long run, actively managed funds will find it difficult to beat the benchmark, because as market matures, alpha generation ability of the actively managed funds diminishes, because you are competing with all the institutional investors, rather than when market is at initial phase, wherein size of institutional investors is lesser, and they are competing with retail investors who get swayed by emotions rather than rational decision making. So that's why one should allocate to index funds core part of their portfolio, and to meet their particular objective they can top it up by investing in a typical actively managed fund, such as he may choose to invest in a thematic fund where if he feels.
So to use your Warren Buffett analogy, would you say that India is at an earlier stage or later stage, or?
So I would say gradually. So for example, US, it took a lot of years, for example 30-40 years in US for passive funds industry to grow, because that particular time information edge was available to few select institutional investors, but because of technology, each and every, even layman has same information about company's financial as I do have. So because of technology evaluation, the time horizon gap for passively managed funds to pick up has reduced dramatically. So I would say currently Indian market is not mature enough to, so that actively managed funds will find it very difficult to beat the benchmark on consistent basis. But I would say in very soon, maybe 2, 3, 5 years time down the line, we will see evaluation of strong growth of actively managed funds.
Right. Okay, so that brings me to one of my last questions. So how do you start investing? Do you start with a small amount? Can you go with a bulk, like a lump sum, or do you combine both and put a lump sum and then also continue with SIPs or systematic fund investments? What's your suggestion?
So ideally, as an individual investor, one should start by way of SIP approach. So time in the market is more important than timing the market. So if you are investing for very long term, in that case your money will compound at a very faster pace. So one should start investing as early as possible. One should start with smaller amount. As your income grows, you can increase your allocation towards equity, and then whenever you feel that market is very attractive in terms of valuation and past returns are quite weak, in that case you can increase your equity allocation. We have seen that past studies suggest that whenever markets are trading at lower than 10-year average valuations and past performance is weak, so for example last couple of years performance is weak, those are the best time to invest in equities, because generally equities reverts to mean. So market as a whole reverts to mean. Individual stocks may or may not reverts to mean, but market as a whole always reverts to mean.
So now sitting here, do I have to, or can I only invest in funds or index funds that are connected or linked to Indian indices, or do I have global opportunities as well?
So there are a couple of funds which are linked to global indices as well. But I believe that since India is in a sweet spot in the sense it is going to become from developing countries to developed countries in time to come. So within India we have a lot of opportunities for generating long term returns for equity fund.
Okay, so you are saying stay focused on the domestic market rather than okay. So now should I look for new? Is there any merit in looking for a new, like an NFO, or is it or should I stick to an existing of the 80 plus funds that you talked about?
So one should ideally invest in so whether you are investing in an NFO or existing fund, the choice that you have to make is which particular index you are going to invest. So if you feel that I want to be little conservative and invest in really large and mega cap, one should invest in Sensex or Nifty based index. If you believe that I want exposure of smaller size companies, because if Indian economy grows, in that case smaller companies, medium sized companies will also participate. In that case one can get exposure of equities through Nifty Next 50 or mid cap based indices. But first one should begin with either Nifty or Nifty Next 50, because these are top 100 companies. First Nifty is comprising of top 50 companies, which captures around 2/3 of India's listed companies universe, and Nifty Next 50 captures another 15% through Next 50 stocks.
So you've not mentioned the Sensex. Why is that?
So for example, no, one can always invest in Sensex, Nifty or Nifty Next 50. Nifty is slightly more broad based as
Correct.
compared to Sensex.
But how much? No, this is a question which I'm sure people also would like an answer to, even if they don't invest in a Sensex. But Sensex is what we all talk about, or at least most of the times. So why would that not be representative or sufficiently representative for an index fund?
No, both are representative, but if you are investing in a one, no point investing in another, because more or less there is a high amount of overlap between Sensex and Nifty.
Oh, so you're saying there is an overlap?
There is a huge amount of overlap. For example, Nifty has 50 largest companies, Sensex is 30 largest companies. So Sensex is subset of Nifty. So you have to make a choice whether you want really mega companies. In that case, you can invest in Sensex based index funds, or if you believe that I want 50 or 100 companies, in that case you can invest in Nifty.
So now the index itself, in this case, is constructed by a Bombay Stock Exchange or a National Stock Exchange, but there could be an index which is not constructed by either of them, which a fund could be linked to, right? And are there examples of those, and if so, should I trust it as an investor, or should I stick to these kind of well-known indices?
So for example, these are the well-known indices having almost 30-40 years of history. So by investing in these funds, you know what kind of philosophy that they are following, and these are typically market cap based indices. So for example, Nifty is top 50 companies in terms of free float market capitalization in India. So if you want flavor of top companies, you can invest in Nifty, or if you want smaller size, you can invest in Nifty Next 50 or mid cap based indices. There are other indices like MSCI India, but those are mainly followed by FIs as compared to domestic institutions.
Okay, yeah. So that was my question. So there is an MSCI, or what was once Morgan Stanley Capital Index. Some questions from our viewers, and then I'll come back to the last question on the market currently. So how often do fund houses provide fund sheets for index fund performance?
So for example, using value research online or any other online service providers, you can check your performance on daily basis as well. But mutual funds publish fact sheet on monthly basis. So at the end of every month, and we are publishing a fact sheet which is showing the current portfolio of the fund, as well as performance over 1, 3 and 5 years time horizon as compared to benchmark.
Okay. So you're saying, and that do you send that as a by post, or do you send it by email for those who want to know?
So these kind of generally we have gone paperless as much as possible. So by logging into mutual fund website, for example, if you can log into utmf.com, you can get all the data regarding our own funds
and all the fact sheets. Okay. So another question which I think is useful and important: is it possible to get dividends from an index fund?
So I would say currently the laws regarding dividend. So I prefer investing in growth scheme as compared to dividend option. Why? Because whenever I need money, I can redeem my few of my units rather than mutual fund scheme declaring dividend when I don't need it. So I would say I can plan my financials better if I am investing in growth scheme, and whenever I need money, I can redeem few of the units. But so for example, we do have both the options, dividend and growth, for index funds.
Got it. Okay, here's another question. It asks, is an index fund an ideal investment avenue for retirement? I mean, you've answered this already in some ways, but
yes, very much. So you are talking about a person who is nearing to retirement?
No, let's say midway, maybe I'm 40 years old or 35 years old, and retirement is a little time away. So is this something that I should be investing in today? So and then maybe you can answer that question as well. Is it something that I should look at closer to? Yeah.
So for example, if you are middle age and you have almost 20 years time horizon, you can definitely invest in index funds, because these are simple to understand and low cost vehicle to get exposure of equities, and you should have higher allocation towards equities initially, and as you come nearer to your retirement, you can reduce exposure to equities.
Okay. And then shift to debt, is that
right? Shift to debt.
Okay. Does investing in an index fund help save tax as per the old regime?
So in terms of taxation, index funds and actively managed funds, there is no difference.
Okay.
Both are similar. So you have to pay your long term capital gain, short term capital gain if you are investing in index or any other actively managed equity funds. So taxation laws are similar for index funds and other actively managed equity funds.
Okay. Okay, so let's come to the market now. So, this is a general question and a specific question. So, generally, yes, is this a good time to put money in? But specifically, because we've seen the markets being battered all over the world and not just in India or in India as well, what should one do?
So, for example, market has corrected more than 20% in last couple of months, and it's trading at lower as compared to 10 years average valuation in terms of P ratio or any other ratio that you may look at. And at the same time, bond yield has also fallen. So, on relative scale, equities have become much more attractive as compared to standalone basis. So, we have done a lot of studies, and we believe that if you look at past pattern, investment in equities is the best time to invest in or increase allocation to equities is the best when they are trading at lower than 10-year average valuation, because generally typically equity indices, they always revert to mean. We have seen it time and again that sometimes they will remain lower as compared to average valuation, but they have tendency to come back to mean valuation. Just to answer it differently, for example, whenever market corrects, market will only correct if current news flows are negative. Either it may be related to coronavirus or global markets falling because of this concern. And whenever market is at peak, all the information that you are getting is going to be positive. So, rather than getting swayed by news flows related to markets, global markets or any other types of news, one should ideally anchor towards valuation. We believe that those are the best times to invest when valuations are attractive rather than they are expensive.
So, the other way of, okay, let me put the question again in two forms. One is, if I am an investor already in an index fund, where do I stand? Because clearly I am looking at a huge fall. And the other is, of course, if I were to get in today or start today, maybe things could be better looking because it's only, there's more way to go up than to maybe go down. So, how would you respond to that?
So, I would say one should follow SIP approach, and whenever markets are trading at attractive valuation, you can top it up by investing lump sum amount. And one
so, you are saying if right now would be a good time to do that?
So, I would
because if I am already invested in an index fund today and I have seen the indices fall 4,000-5,000 points in India, then I should be topping up is what you are saying.
Right.
Okay.
Because the valuations are very attractive now, and if we believe that long term India growth story is intact, and these kind of news flows will always come. So, we have seen it time and again, market corrects 10, 15, 20% and then they bounce back. Even after global financial crisis in 2008-9, within 24 months market made new high. So, market will always revert back to mean. So, one should not get swayed by these news flows and ideally should follow their asset allocation. And whenever you feel that markets are trading at attractive valuation, you can increase your allocation towards equity. One should not go whole hang towards equity at one go.
Right. And finally, you know, we've begun the year, as in we've got a new financial year coming up. Is this the best time to start? You know, when as you go into a new financial year, or is that not? Does that not have any relevance at all? And any advice on that account?
So, we have few challenges as we go towards new year, because the GDP growth rate is slightly weaker now, but it's going to improve going forward, maybe in medium to longer term. It's going to touch 7 to 8 percentage point. So, and most of the macro linked fundamentals are intact even today, but there will always be few metrics which are in different metrics. For example, few metrics will be at peak, few metrics will be at bottom. So, this is going to always happen. So, one should ideally follow its asset allocation rather than look at few news flows.
Got it. And my question was also about ending of financial year, beginning of new financial year. So, that you are saying is not something, therefore, that matters.
That doesn't matter much.
Right. Okay. And are you generally feeling calm and breathing well despite all the markets behaving the way they are?
Yes, very much.
Because you're sure about.
I am very much sure that long term Indian fundamentals are intact, and these are challenging time because the issues related to coronavirus. Because generally whenever market feels any uncertainty, market doesn't like uncertainty, In uncertain time, generally market corrects, and sometimes
Overcorrects.
overcorrect as well.
Right. So you are saying anyway. So stay calm, stay focused on the India growth story, the future, the fact that the companies will deliver, and a great way to ride that story is to focus on index funds. That's a good note to end on. Shravan, thank you so much for being with us.
Thank you.
Well, that's all we have time for on this edition of UTI Swatantra. We're going to be back very soon with another exciting edition of how to invest in mutual funds and what is the best strategy that you should be following to make your future secure. Thanks for watching.